So I want to start off, I want to welcome everybody. Thank you for attending today's presentation on apartment investing with our special guest, Eleena de Lisser. Eleena de Lisser is a real estate investor who started investing in apartments in 2015. In less than 2 years, she went from 0 to 1,008 apartment units and is currently an equity partner in 4 large apartment communities, Eleena understands the challenge of real estate investing while still working a 9-to-5 job. She's Director of Marketing Communications for a division of the Wharton School of the University of Pennsylvania and a former journalist with the Wall Street Journal. A graduate of both the University of Pennsylvania and Columbia University, Eleena is a creative strategist and problem solver who brings a keen business insight and extensive experience as a marketer to real estate investing. She believes in the power of real estate to build wealth and create a financial legacy. I want to start off with this disclosure. This is just letting you guys know it's put together by an attorney to let you guys know we're not attorneys, CPAs, financial advisors. So if you need any of advice in those fields, please contact the necessary professionals. At Camel Plan, we don't offer any investments. We don't sell anything. So of course, do your own due diligence. We can't stress that enough with any investments that you look on doing. And I want to pass the mic over to Eleena, and she can start her presentation.
Okay, great. Thanks a lot, William. So everybody, thanks a lot for coming today. We're going to talk about the good, the bad, and the ugly when it comes to buying apartment buildings. So you are in the right place if you are currently owner of single-family rentals and you want to transition into multifamily apartment buildings. Or if you're seeking an alternative investment to invest your self-directed IRA funds, or maybe you're just simply curious about investing in multifamily properties, all are welcome. This is a safe space today, as I'm going to give you a very, very quick introduction into the world of multifamily. So you already got my introduction. Yes, I work at the Wharton School, Director of Marketing Communications. Before that, I was a reporter with the Wall Street Journal in New York City. And I'm just mentioning all that to say that I have a head for business and I'm comfortable talking about business issues. I've been investing in apartments since 2015. And I've gone from 0 to 1,008 units in less than 24 months. And locally, if you are here in the Philadelphia metro area, I am the organizer of a meetup group called Apartment Investing for Busy Professionals. And I'm also the host of a weekly radio show on a very small public access radio station here in Philadelphia. And the radio show is called the Jumpstart Philly Real Estate Radio Show, where I interview other investors and real estate developers here in Philadelphia. Okay, great. So here's what you'll learn on this webinar today. You're going to get some of the pros and cons of investing in apartments. And I'm going to also, give you some insight into how you can get started. So first, the good. Why do I love investing in apartments? Well, the multifamily sector has posted some of the strongest long-term performance among all commercial real estate sectors in the last decade. And so if you're somebody who is interested in real estate and you're thinking of commercial real estate, apartments are really a good bet. Apartment turnover in terms of the tenants is more frequent than commercial tenants. So for people that are thinking of mixed use, like a storefront with apartments up top, or restaurants, hospitality, all of those have their pros and cons, but apartments really have a lot of good attributes that make it an ideal step up, particularly for people that have started with single family. Okay, so first of all, the economies of scale. So basically, and I know for some of you, this will probably be very, very obvious, but there's a big difference between having one building that has 10 apartment units in it and 10 single family houses. If you have an apartment building that has 10 units, if one of those units goes vacant, you still have 9 other units that are hopefully occupied and generating income to cover your expenses and your mortgage. Whereas if you have a single family house and that house goes vacant, that house is vacant. So even if you own 10 single family houses, if one of them goes vacant, you still have to get income coming in from one place that's now vacant. So the economies of scale, you've got one roof, one heating system, plumbing system. When it comes time to lease out the units, you're going to one location. So that's just way more efficient. Also, the method of valuation, it's all about the income, baby. So going back to this example of, let's say I have a 10-unit apartment building, and my brother also has a 10-unit apartment building right across the street from me, but my brother's not taking care of his apartment building, even though it's the same vintage, same year of construction. He's allowed his apartment building to run down, and I'm keeping mine well maintained. I can charge a higher rent. He can't. And so with single family houses, you have people thinking that because they have a beautiful house in a neighborhood, and it's the most beautiful house on the street, that they should automatically get more rent for that house. That's not necessarily the case. Whereas with apartments, you can force the appreciation by fixing it up. And there are different ways to force appreciation. Sometimes you can raise the value of an apartment building without having to raise the rents. There's all different means to generate more income out of a building. The next thing is professional property management. A lot of times when people are doing single family rentals, they have to manage them themselves, or it can be very time consuming and costly as they use a series of realtors and handymen to do it. If you own an apartment building, you can get professional property management. Now, property management is difficult for everybody in real estate, regardless of whether it's commercial or residential. But with apartment buildings, particularly the larger apartment buildings, the expectation is that you're going to have professional full-time management. And then also, as an investor in apartment buildings, you can become an asset manager, not the landlord. You are somebody who owns an asset. You manage the asset. And as the asset manager, you are managing the property management company. So how is that different from a landlord? Well, the landlord is the person who's getting that tenant phone call at 2 a.m. when somebody's kid has thrown the G.I. Joe doll down the toilet, and the landlord's the one that has to go out or has to call the handyman to go out. And, that's just not for me. Whereas with the asset manager, you have a group of investors, hopefully, that you're dealing with. You are making sure that the property manager is doing what they're supposed to be doing. So it's a much more professional operation. You are buying a business when you buy an apartment building. And I think that's a completely different mindset than buying a single family house. A lot of times when people buy a single family house, they immediately start thinking, oh, is this a place that I would want to live in? Is this a place where I could see my son or daughter living in? With an apartment building, you're buying a business. And so the emotion, it shouldn't be part of the decision, the buying decision. And then also with apartments, you can do syndication, which is basically pooling your money from multiple people to buy a building as a group. And that's how I've been able to be involved in so many deals in a short period of time, is that I've taken my IRA money and I've pooled it and invested it with other people to buy buildings as a group. And then of course there are tax benefits. Everybody's tax situation is different, but there are tremendous tax benefits depending on your circumstances that can be very powerful when you buy apartments. And then ultimately, of course, you're doing good. You're providing housing to multiple people in one location. And particularly for those of you on the line that want to invest in something that has a social impact, there's definitely a lot of ways that you can affect a community in a positive way by being an apartment investor. Okay. So one of the things, let me just scroll like here. So one of the things I talked about at the beginning was property management. So property management is obviously one of the good things about buying an apartment building, that you can get professional property management, but it can also be one of the bad things. Good professional property management can be hard to find at times. And generally speaking, as a rough rule of thumb, you typically need to have 100 units or more to have a full-time property manager. So a lot of times people ask me to look at their deals and they want me to partner with them on deals, and they're very small apartment buildings, 10 units, 20 units. To date, I have not invested in anything less than 100 units. And the reason for that is because of the property management situation. Now, that's not to say that I would never invest in a small property, but the attractiveness of buying an apartment building is that you can, you can contract out or have somebody taking care of the property management for you. And so, like I said, a rough rule of thumb is 100 units or more, you can have a full-time property manager. Under 100 units, I think, again, it's going to depend on the building, depend on the area. But once you kind of get below, I would say 60 units, then it's going to become a little bit more expensive and a little bit more time consuming. But the other thing too with property management, why property management can be one of the ugly or the bad things about apartment investing, is that your cash flow can be severely impacted by incompetent or inefficient property management. And here's the thing, everybody talks a good game, but you really, really have to ask a lot of tough questions when you bring on a property management company. I have seen situations with other investors where they have gone after the blue chip, well-known local property management company, and then that property management company doesn't specialize in the small apartment building that this person may have. So you really have to make sure that the property management company is a good fit, and that obviously that they're going to be highly ethical and efficient in terms of how they run your property. The other thing too that is part of the bad part of investing in apartments right now is that your competition is no longer local. And I know that this might seem very obvious, but it has really, really accelerated in the last few years. And also the sellers are more savvy. They know, particularly if you're looking at a major metropolitan area to buy your apartment building or to invest in an apartment building, there are a lot of out-of-state buyers. So here in the Philadelphia area, there are lots of people from the New York area, North Jersey, Maryland, DC. And then there are also a lot of international buyers. Now, in light of everything that's happening in the world right now with China and the coronavirus, who knows what the future holds. But in recent years, there have been a stream of foreign buyers from China, from Latin America, who have wanted to invest in commercial real estate in the United States. And I've seen Chinese buyers go after 100-unit apartment buildings. So it's not just the skyscraper building in New York that the international buyers are going after. A lot of people say, oh, people from Latin America, why are they investing in the United States? Well, depending on where they are in Latin America, there's a lot of economic and political uncertainty in some of these countries. And if you have any bit of wealth, you want to move your wealth to a market, a country where the rule of law means something, and where you can, basically park your money and be pretty assured that it's, that the government's not going to take it from you. So because of that, the international buyers have a completely different criteria a lot of times in terms of how they value a building. And a lot of times they're willing to overpay. And that's been driving up the prices of a lot of apartment buildings in several markets across the country, because a lot of international buyers are just looking to park their money. They're not necessarily looking to get, a 15%, 12%, 10% cash on cash return, because like I said, they're moving their money from an economic or political environment where, they're just trying to preserve their existing capital. And then obviously, as you get into the bigger apartment buildings, like 200 units and above, you start bumping into institutional investors. And so these are the big boys. And that's not currently a space that I play in, but all of this stuff can have a trickle-down effect. Just wanted to let you know that even when you're looking at a small market in the Midwest, in the South, you would be surprised that, the California buyer, the New York buyer, the overseas buyer are even looking at these smaller markets in the Midwest, parts of Pennsylvania. So it's very competitive these days. And then the other thing too with buying an apartment is that it's illiquid. It's, once you have your money in the building, it can take several months to buy or sell, even in a hot market. So, investing in real estate, you're buying a single family house, that it can take a certain amount of time to sell it. With an apartment building, it could take as long as a year to buy or sell an apartment building. And the economic conditions, financing terms can change dramatically for the worse in a short period of time. So I have just recently gone through a situation like this where one of the groups that I was in, we put our apartment building up for sale, 216 unit apartment building, and in a great market in Texas, San Antonio, Texas. And it took a while. It took a while to sell. And one time we had to cancel the sale because basically what happens, I think I have this later in the presentation. Okay, I'll mention this part about what happened with the mortgage later in the presentation. But the whole point that I'm trying to make here is that when you invest in apartment buildings, it's an illiquid investment. So it's not the sort of thing where you can kind of cash in and cash out quickly. So any money that you put into this, you're really putting it in for a period of a couple of years. It's not something that you can just kind of cash out quickly. Okay, so to summarize, good professional property management can be hard to find at times. Lots of competition, can take several months for the deal to close or to sell, and it's obviously very illiquid. Okay, so the ugly. So the ugly investing with apartments, obviously unforeseen, unanticipated expenses. This is a picture of one of my properties that I've invested in. And this is a real picture. This is what actually happened. Somebody who was driving under the influence, they were strung out on some drug, lost control of the vehicle and went through the building, as you can see in this picture. Fortunately, nobody was seriously injured and nobody was killed. But this is the sort of thing that can happen to you when you own an apartment building. Now, somebody will say, well, the insurance, don't you have insurance? Yes, of course, the insurance eventually did cover it. But we have gone through, in the last decade, multiple major catastrophic events with the insurance industry, just in general, as a society, between the hurricanes, forest fires, all that kind of stuff. So the insurance companies, not only insurance premiums have gone up, insurance companies are very, 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 very slow sometimes to pay out what they should pay out, and they will fight you tooth and nail for stuff. So you have to have an expense, you have to have a reserve fund to cover some of these expenses that are going to pop up inevitably. Typically, what's more typical to happen is a boiler or a furnace goes out, something that you thought you had another 5 to 10 years of mechanical life left on it, and it goes out and it has to be replaced right away. So that can really mess you up and mess up your cash flow for an entire year when you have some of these expenses hit your P&L. And then obviously, again, the unethical, incompetent property management. This has not happened to me, but I know of another investor who had a situation where he couldn't figure out for the life of him why he was getting such bad tenants. He had a property manager who he thought was screening the tenants properly. Come to find out, this property manager owned her own apartment building in the same community. He did not know that. He did not know that she was also an apartment owner. And she was basically sending all of her bad candidates over to his building. And so it took him a while to figure out what was going on, but that's completely unethical. So for anybody who's curious, I've got a whole list of questions people should ask property managers when they're interviewing property managers. But that's an example of sort of unethical behavior that you might see from time to time. Another thing, obviously, is with the finances. Property managers writing checks, paying out funds that they shouldn't be paying out, stuff like that. With regards to the unethical, incompetent, or secretive lead investor, in all of the deals that I'm currently involved in, there is a lead investor, also called the deal sponsor. And I only work with people that I know, like, and trust. But I know that there are people that go to real estate club meetings they meet people, they network, they hit it off, they have a rapport, and then they decide to invest with that person. And then, what can happen, hopefully it never happens to you, but what can happen is that people, their true nature comes out, and that can affect the investment. So I do know of a case, fortunately it didn't happen to me, but in one of the investment clubs that I'm a member in, another investor had a situation where the lead investor was going through a divorce. And it was a very traumatic divorce. And he basically stopped responding to emails. Nobody knew what happened to him. Nobody could find him. He wasn't answering his phone. And come to find out, he was going through a very traumatic divorce. But in the meantime, the rest of the investors were wondering what's going on with the property. We haven't gotten our quarterly reports. We haven't gotten a distribution. And so it got to the point where the group of passive investors got together, and every operating agreement is different, but they were able to, under the standards in the operating agreement, basically to vote this guy out and bring in another person. Now, obviously, they had to compensate him, but that was like a very extreme example. But just letting you know that these things can happen. One thing I would recommend to people, particularly if they decide to get into this on a consistent basis and they want to grow, is to find out whether or not the lead investor, the deal sponsor, would be willing to have what they call a key man insurance policy. So that's basically an insurance policy used in business for what happens to the head of the company. What happens to the head of the company in the event of disaster. Okay. Again, these are very extreme things, but this is what can happen in real life. Okay. So money nightmares. Some of the money nightmares that can happen that can keep you up at night, and I touched upon this already, huge increase in property insurance premiums. Again, depending on what part of the country you decide to invest in, because of all the natural disasters that have been happening over the last decade, the insurance companies just looking for reasons to raise the insurance premium. So you've got to really shop around and do your due diligence with getting the right property insurance. And you want to be fully insured. You don't want to be underinsured. The other issue is huge increase in property taxes, utility bills. In one apartment building that I'm an investor in, one of our strategies to make the building perform even better was to get the water bill under control. And the way we did that was that we paid for an outside firm to come in and basically do a water audit and go through every single unit, and look for leaks, and look, check the toilets, every single thing, and replace stuff that needed to be replaced, because the amount of water that you could end up losing, and particularly if it's a building where the tenants don't have to pay for the water, it's you as the owner, the building owner, that pays for the water, that can be a huge expense saving. So, but those are the sorts of things, a lot of times residents, if they're not the ones on the hook for the utilities, they're not quick to report the fact that, the toilet might be leaky, or there's a slow drip in the kitchen, So another money nightmare is the capital call. So the capital call is what happens when the lead investor, basically something happens. It could be an assessment by the township. Basically something unexpected happens, and the lead investor now comes to the group of passive investors and wants to collect additional funds. So this would be on top of the money that you've already invested in the building. And they're basically coming to you and saying, hey, we need more money to take care of this issue. I have never been involved in a capital call, but those things do happen. They're not likely to happen, particularly if there is a sufficient reserve fund. And most apartment investors usually want to put aside $250 to $300 a month per unit as part of their reserve fund, like a rainy day fund. So that if something does pop up, that the insurance isn't going to cover, or there's going to be a long period before the insurance kicks in, that you've got a pot of money already set aside that you can take care of some of these issues and don't have to go back to the passives and say, hey, we need more money to take care of this issue. So the other money nightmare is being trapped in the mortgage. So this was a situation that happened last summer with one of the properties that I'm in that we were trying to sell. And basically the mortgage was an assumable mortgage, but the banks, it's called yield maintenance. And basically what it is that the banks will charge you a penalty if you try to get out of the mortgage early, okay? So it's basically a situation, it's a prepayment penalty that the banks charge you as the borrower because the banks want you to reimburse them for the loss of interest. So when you take out a mortgage, the lender is expecting to get a certain amount of interest back over a certain period of time. If you come to them and say, hey, you know what, I'm good. I want to have somebody else assume this mortgage and I want to just move on, the bank needs to get its pound of flesh. So those prepayment penalties, particularly on the larger apartment deals, can be pretty severe. And so last year we had a deal that we had the property under contract. And then by the time we got everything, the due diligence, blah, blah, checked with the bank, the prepayment penalty was about $5 million. So that the deal got canceled and we kind of had to go back to the drawing board. And there's more behind how the penalty works, but just wanted to let you guys know that that was something that was completely unexpected. Here we are in a very strong economy, great market, got a great offer for this building. And then to have the bank say, oh, hold up. If you want to get out of this mortgage and have a new owner assume it, there's going to be hell to pay. So, okay. So after all this, with me being a Debbie Downer, is it worth it? Yes, it is. I'm with her. I'm with this lady here on the screen. Thumbs up, definitely thumbs up. Here are, this was just from earlier this week. This is a screenshot from my account. So you hear about mailbox money. Well, I have Camaplan. I have Camaplan money. I love it when I get that little chirp, that little chime on my email account, and I look, and it says update on your account, and I know right away that it's an email from Camaplan. So this was money that I got this week. This was related to a partial sale of an apartment building, and this was in November. This was this was from a sale. This was a return of my capital plus plus the gravy on top. And all of these are in addition to getting these large amounts on a monthly basis, I also get the smaller amounts for the monthly cash flow, depending on what the building is and depending on what the performance is. And then this was a refinance. This is a really good one. This one I invested $50,000 and I got back $33,000, and I'm still in the deal 100%. And so, you know, the cash flow that I'm continuing to get, I mean, it's fabulous, because right now I'm only in for my original investment that's still left in there is $17,000, right? So, yeah. And so the cash flow that I'm getting on a quarterly basis for this deal is working out really, really well because of this refinance. So anyway, how do you get started? Lots of people are interested, and you know, to get started, definitely you need more education. What we're going to be doing in a couple of weeks at Camaplan, I'm going to be doing a more in-depth workshop about buying apartments. It's going to be on a Saturday, March 14th from 9 a.m. to 1 p.m. It's going to be at the Camaplan headquarters. And here's what I'll cover during that day. I'm going to go into a little bit more depth about the different types of apartment buildings and which ones make the best investments. I'm going to talk about where can you find apartment buildings for sale, particularly in this current climate. I'm going to also talk about how to tell whether an apartment building is a good deal or not. So just because an apartment building's for sale and you can afford it doesn't necessarily mean that you should buy it. And then if you want to be a true passive, I'm going to talk in depth about how to vet and screen deal sponsors if you want to be a passive investor. I think that's huge, and I have a lot of information to share about how to how to basically do detective work and figure out whether this person who wants to be the lead investor on the deal is worth your money, worth investing in. And then I'm going to talk realistically about how much money it does take to get started. A lot of people will say you need to have a lot of money. It depends. And then obviously we'll talk about how to invest in apartments using your self-directed IRA account, retirement account. So that's pretty much it in a nutshell. Obviously, if you're interested, please go to camaplan.com to register. And if you click on Cama Academy and then click on upcoming events, you'll see the promo for it, the page for it. And we're going to charge for this workshop because it's going to be way more in depth than this webinar, and it's going to have a lot of substantive information. But if you put in this promo code when you go to that registration page, WEB50, they'll take 50% off the price. So I think we'll open it up now for questions. William, has anybody put any questions in the chat?
As of yet, I don't see anything in the Q&A section, so please feel free to leave any questions for Eleena in the Q&A section. And I think I realized in all the excitement in the beginning of the presentation, I failed to mention the Q&A section down here, and I also forgot to introduce myself, I think. I'm William Bucker, and I'm a client executive with Camaplan, and I'll also be at that event as well.
Great.
We do have a comment that, can you comment on anyway on emerging markets?
Okay, so when I hear emerging markets, people have different definitions for that. In terms of how I would describe an emerging market to me is a market that hasn't fully taken off, and it could be for multiple reasons. Definitely, I think that people should look to invest in a market that has economic growth, that has multiple layers of different kinds of employers. So let me explain that. For example, there are lots of apartment buildings down south, particularly in North Carolina and South Carolina. And hey, William, can you do a quick Google search for me and tell me where Fort Bragg is? I think Fort Bragg is in South Carolina.
Yeah, let me look that up for you right now.
One of the military, basically Fort Bragg, one of the towns down there, has a lot of apartment buildings, and there's a lot of opportunity to buy apartment buildings. I personally would not look to invest in an area that relies solely on the military for their tenant pool, because depending on what happens, the government could decide to close a base, and then if that is the primary major employer in that area, the economy could go to hell in a handbasket overnight. Now contrast that with in Spartanburg, South Carolina, BMW has a plant there. And so people are like, well, Eleena, I thought you said you don't want to invest in an area that relies on one employer. Well, the issue with BMW is that BMW as a car manufacturer, first of all, has gotten billions of dollars of incentives from the state of South Carolina to operate there. And car manufacturers have a whole ecosystem of other businesses, car parts, all the different suppliers that pop up to support a car manufacturer like BMW. So that economy there in Spartanburg, South Carolina, it would take a lot. It would take a lot for BMW to pick up and move. So I look for a market that has good economic indicators. If it's an emerging market, it needs to be moving in the right direction. For the person who asked the question, I'm not sure if they were asking me to name specific geographic areas. So if you guys were looking for a specific geographic areas as to what I think is an emerging market, put that in the chat. But I typically would like to invest in an area that has at least what they call an MSA, a metropolitan statistical area, basically the population of at least 200,000 people and above. Definitely looking for a place that millennials would want to live in. It's gotta have, it's gotta have a good mix of young people, middle-aged people, old people, not looking at me personally. And that's the beauty of real estate. Some of you listening on this call might be like, you know what, I only want to invest in a place, a college town, or I only want to invest in a place that has a lot of seniors. Well, that's the beauty. There's so many different ways that you can play it in real estate. And if you want to invest passively, there are so many deal sponsors out there doing deals for different markets and different types of apartment buildings that you can with a lot, with a lot of networking, you can find your fit.
Perfect. Thanks, Eleena. We do have a lot of questions streaming in now, and I want to note that there's a comment section. There's also a question and answer section. I'm going to mostly be dealing with the question and answer section. We have a question. Can you talk about the requirements and structure to become a deal sponsor?
Yeah, so I see that right there. Okay, so to become a deal sponsor is basically you're saying that you want to be the lead investor, and as the lead investor, you want to be the person who's putting the deal together. So that means that you're identifying the property, you're getting it under contract, you are working with the bank to line up financing, you're working with a property management company to get them on board. So that's a lot of work, okay? And on top of it, you're going to be raising money from other people to buy that building, right? So I wouldn't say there are any set requirements. There's like no official federal requirements to become a deal sponsor. But just keep in mind that if you want to put together your deal together and you don't have a track record of doing anything in business like this, it can be very, very, very difficult to get the bank to give you money and to raise money from other people. So that's why it's so good to look for people that you can partner with. I know people who are doctors who thought that they could do this on their own because they had money. And a lot of times the banks still want to see, even if you are a high net worth person that has money, the bank still wants to see that there's somebody on your team who is part of the management team of the deal, who knows something about real estate. And so sometimes you might see a doctor partner with obviously another investor who has experience, or they might bring in a professional property manager as part of their team in order to convince the bank that they should give them a loan. And that also helps raising money from the investors as well too, because people want to invest their money in something that they know is going to work. They're not looking for, they don't want to be somebody's experiment. So if you're looking to become the deal sponsor and you've never done a deal before, definitely you want to look for start networking with other real estate investors who you could potentially partner with, and really bring a strong case to the table once you start raising money from other people and going to the bank to get the mortgage.
Awesome. Another question we have here is, can you expand at all on your forced appreciation strategy?
Yeah, so it's fascinating. Okay, so there was this one property in North Carolina, Winston-Salem, North Carolina. It was a 60-unit apartment building. It was owned by a doctor. And when I saw it, I got so excited because the property from the outside looked very well maintained. And I made an offer, got it under contract. And that's when I started to see the skeletons in the closet. And one of the things was that the property, although it physically, if you drove by it, you thought, oh, this is a very well maintained property. On paper, it wasn't managed properly. So this 60-unit apartment building had one or two units that were completely vacant, and one of them, the doctor was using as a storage closet, a 2-bedroom. He was using a 2-bedroom apartment as a storage closet for the handyman. So here was a 2-bedroom apartment not generating any income because this doctor had given the keys to the handyman to store his leaf blower and all that kind of stuff. So we had that situation. We had a situation where in that same complex, there were several people that were only paying $300 a month rent in a place that could be getting more than double that. Come to find out, they were friends. They were children, they were adult children of friends of the doctor. It was a situation like that. So in a situation like that, my first plan of action was to get those units properly leased and generating money right off the bat. And that's not even doing any renovation. No renovation required. It's basically having those units start generating cash. So, but forced appreciation, another investor that I know had has a very smart strategy. When he goes into, when he acquires a building, he doesn't automatically, and if the building requires extensive renovation, of course you have to renovate it, the extensive renovation. But we're talking about a cosmetic upgrade. So he would buy this apartment building, and instead of going in and then deciding in the first year he's going to upgrade all the units with stainless steel appliances and new flooring and all this kind of stuff. No. What he would do first is he would improve the exterior, increase the curb appeal of the building, because that is a very powerful symbol in the neighborhood when people can tell that a building's under new management and they can see it right away. So fixing up, sprucing up the exterior, and that's not something that's necessarily going to cost you an arm and a leg. Could just be some basic landscaping, putting up a new sign. That's huge. Then when you go inside the apartment building, what he decided to do was he decided to create a good, better, best tier so that he would have the ability to upsell tenants within his own property. So instead of upgrading all the units to the premium package, he kept the classic, unrenovated version. And then he had like a mid-tier package. And then he had the premium package. But the whole idea being that for the existing tenants, they had something that they could aspire to move up to within the same apartment building. And then for people that were coming from the outside, it was the same idea. And then he was also thinking if there was ever an economic downturn, he would still have the ability to have different tiers of rent as opposed to being trapped into a situation where he completely upgraded the entire inside of the building and then, not being able to successfully get that level of rent on all of those rehabbed units. So there's so many different ways to play it, but those are just some ideas that I'm putting out there. Another thing too is looking for storage, looking for opportunities to provide room for people to do self-storage. So a lot of times, particularly here in the Northeast, you have these older apartment buildings that have basements. The basements are moldy, they're dank, maybe there's a washing machine down there. Okay, clean up the basement, put some storage lockers down there, charge people $10, $15, $20 a month. Bam, there you're generating more income from a space that the previous owner thought was a complete dud. So there's so many different ways that you could potentially increase the value of your building by doing these different tactics.
Great, thanks, Eleena. We have some questions aimed towards you and some aimed towards Camaplan and self-directed IRAs. So I'll answer a quick one aimed at Camaplan, and then we'll bounce it back over to you. Somebody's asking if Camaplan sponsors deals for our investors. As I said in the beginning of the presentation, Camaplan, we don't offer any investments. We don't promote anybody. Everything we do is out of educational purposes. So we would be more than happy to provide educational material so that potential investors understand the ability to invest out of their IRAs, but no, we don't do any endorsements or sponsor anybody. But you can definitely call into our office or email me for more information about that. You can email us at info@camaplan, and I'll be sure to respond pretty promptly. Now back to you, Eleena. Let's see, how do you vet deals that are out of state?
Yeah, so a lot of people are uncomfortable, afraid to invest out of state. I think that particularly for those of us that live here in the Northeast, you got to expand your horizons and you got to be open to investing out of state. So what I've done is I've networked like crazy. I mean, it's so great that, you know, we live in a time where people are comfortable connecting, communicating, getting to know each other online. Um, I will tell you that Atlanta is a market that I'm interested in, and I have been able to research deals through networking with other investors. For example, there was a situation where I was looking at an apartment building in the Atlanta area, and what I did was I looked for the I forget what the exact name of the association was, but I basically looked for like the Georgia Property Managers Association, and I went to their website and I looked to see who the president was, and I sent an email to this guy. And I said, hey, I'm an out-of-state investor in Philadelphia. I'm looking for a property manager in the Atlanta market who can give me the scoop on a building that I'm looking at. And this guy said, tell me what the building is and blah, blah. So believe it or not, this guy, you know, he was the president of the Property Managers Association for the state of Georgia, but he was also an active property manager. And I gave him the address. And a couple of days later, he called me back. And so I was able to get a lot of intelligent detail about that community, about that neighborhood, about the building, just based on this guy who was on the ground. But I find that networking with other investors is huge. There's a website called biggerpockets.com. They have a very, very active online forum where you can ask questions, you can connect with other people. You can find people in different parts of the country. I highly, highly recommend that as a first wave of getting to know people in different markets. I will say that for the investments that I'm in, two of the investments I'm currently in, I was referred to by a mortgage guy. I was trying to get a mortgage for an apartment building, and my deals weren't working out. And so I said to this mortgage guy, I said, who else is doing deals that you're doing loans for? Can you introduce me to them? And he did. And so two of the deals that I'm in were as a result of the commercial mortgage broker guy introducing me to two of his clients and saying, hey, here's another investor who's looking to invest. And so you just have to be creative. Obviously with those people, you know, I got to know them. I went out and visited with them. It can take time. It can take time. But that first year that I committed to getting involved in apartment investing, I easily like went to like 10 different conferences. I like networked like crazy. So it's very, very important to find other investors who are in the market that you're looking to buy, and see if you can pick their brain, see if you can partner with them. A lot of people are very generous with their time if they know that you're serious. And people are always looking to partner with other people. So I would highly recommend that you pick, 2 or 3 out-of-state markets that you're interested in, and educate yourself on those markets. Find out who the major employers are. Find out what the current economic climate is, and find out if there is a local real estate club. They're called RIAs, R-E-I-A. Look to see if there's a RIA in that area, and then see how you can get connected with people through that group. But yeah, in terms of vetting out-of-state deals, the first step is definitely to vet the market, make sure that the economy is moving in the right direction. And then if you need to get boots on the ground, look for other investors who are already in that market to see if they can tell you anything about the property, if they'd be willing to drive by the property before you get on a plane or drive out of state to go look at something.
Thank you, Eleena. That's very insightful. Here's a question that's aimed towards camera plan, but I think you can have, if you'd like, you can put some input on your experience. Somebody's asking, how do they use their camera plan account to invest in apartment deals? From our standpoint, it works the same as any other transaction, except for the investor on the supporting documents, whether it be a subscription agreement or some sort of note. The investor is not going to be you personally. So it wouldn't be me, William Mucker. It would be my IRA, which is something along the lines of Camaplan SBO, which stands for benefit of William Mucker's IRA. You'll initial next to the subscription agreement, give us our asset purchase directive, a very simple form. We'll process that within 48 hours, sign on behalf of your IRA, and then you'll be able to see that asset inside of your account, just like a stock or bond at Charles Schwab or somewhere else. Eleena, how was your experience, if you don't mind me asking?
Yeah. So, I mean, I will say, as somebody coming from the Fidelity Vanguard world, because, before I got into apartment investing, I was like the classic, mutual fund stock person, and I still own stocks. But so when I initially got interested in buying apartments and doing real estate through the IRA, I will say that initially I was highly skeptical about Camaplan because I couldn't find anybody in my circle. And that's why it's so important to network with people. I couldn't find anybody who was using Camaplan. And then I got involved in a local real estate club called Dig, and people at Dig would tell me about Camaplan, but I was still kind of skeptical. And so I finally was like, okay, let me pull the trigger on this. And so I went to move my money from Fidelity to Camaplan as an IRA rollover. And I will never forget this. When I called Fidelity and I told them I wanted to do a rollover to another IRA custodian, they said, well, what was the name of the company? I said, well, it's Camaplan. They're in Pennsylvania. And then the agent said to me, the Fidelity person said to me, oh, they're not on the drop-down menu. So I'm like, so what? And they're like, well, are you sure it's a legitimate company? And I'm like, yeah, I'm sure it's a legitimate company. And they said, well, can I remind you that we're on a recorded line? This is what the agent said to me. We're on a recorded line, and you were about to take an early distribution. I was like, no, I'm not taking any early distribution. And
Wow.
so Fidelity put the fear of God in me that I said, you know what? Maybe you're right. Maybe you're right, Fidelity. I don't know what I'm talking about. Forget I even called. I'm going to hang up right now. Do not take any action on my account. And it was a very unsettling experience because Fidelity, Vanguard, Charles Schwab, TD Ameritrade, none of them can make money off of you investing in real estate. And so they will, they won't tell you, they won't tell you about self-directed IRAs. So that's why it's so important to network and to get educated. And it took me, no lie, it took me like a couple more months after that, because I was so unnerved. I was so unnerved by that conversation with Fidelity where they're like, you're about to take an early distribution. And it's like, oh my God. So when I came to Camaplan, Camaplan is just a custodian. Camaplan is not going to hold your hand. They're not going to advise you on whether this apartment deal is a better deal than that deal. That is not their role. So for me, coming from the world of TD Ameritrade, and that's, no knock on TD Ameritrade. I still have an account with them. And my relationship manager still calls me every month saying, hey, what's going on, blah, blah. But because I still have money there. But Camaplan is not going to advise you on which apartment deal is better than the next. So that's why it's called a self-directed IRA. And, this sort of investing is really for people who want to take the reins, want to take control over their financial life. Partly why I was drawn to Camaplan was because back in 2008, I was fully in with Fidelity and Vanguard. And I saw 40% of my investments wiped out in 2008 because of what was happening in the economy. And I will never, ever forget how helpless and out of control that I felt, that through no fault of my own, something happening on a macro level. And that's when I started really thinking seriously about getting involved in real estate, because I was like, this is crazy. This is ridiculous that I had literally no control over what was happening in my investment account because it was out of my control. So with the self-directed IRA, this is not about putting something on autopilot you've got to pay attention to what you're investing in. You got to be fully present, and it's on you. It's on you to succeed. So Kama Plan is a custodian. Like I said, they're not going to advise you the way a Charles Schwab, TD Ameritrade, but that's not their role. And so if that makes you feel uncomfortable, then maybe this isn't right for you, you know. But if you're somebody who does want to have more control over your investment life, I highly recommend using a self-directed IRA. And real estate is a good way to basically see some progress in your retirement future.
Very well put, Eleena. Thank you. That's and let me specify, Eleena de Lisser. Somebody's asking for your full name. But yeah, that's an interesting story. I actually started off with helping clients facilitate their funding transactions, transfers, or rollovers, and it's amazing how sentimental these companies can be with your account, more than yourself. But the IRAs you open with us are the same that you would open anywhere else. Traditional, Roth, same rules apply. Self-directed is just an adjective. All of our accounts are self-directed. So moving from one retirement account over into a similar tax status IRA or 401k, it's not a taxable event. And you can always look this information up on our due diligence page. Let's see how many more questions we can get to. I might do one more at least. Do you have any suggestions for non-accredited investors who are looking to invest in syndications? They have assets but are not accredited.
Yeah, so I will say that I started off as a non-accredited investor. I'm accredited now. But yeah, I mean, if you've got the interest, and if you've got at least, I would say if you have at least $25,000 to invest, you can find a deal sponsor out there that would want to work with you. So yes, there are several apartment deals where the deal sponsor does not want to deal with non-accredited investors. But for some of the smaller apartment deals, like under 100 units, around 100 units, yeah, you can find deal sponsors that would want to work with you. Particularly if you've got I'd say at least 25K. 50K would be good. But just because you're not accredited doesn't mean that you can't invest in apartments. And William, I don't know if we want to explain what accredited is and non-accredited, but if anybody wants us to explain that, we can. But
we could go more into accreditation later, or if we have information on our website as well about that.
Yeah. We can get
I might try to keep it as straightforward as possible.
Yeah, that's fine.
Perfect. Let's see if we, I'll try to do, how much more time would you have to answer some questions, Eleena?
Let's take one more and then we can wrap it up. Because I want everybody to do the workshop. We can ask more questions.
Absolutely, yeah. We can't give it all away now.
Right.
And plus we're running out of time. So here's a good one. This is, I guess, a little bit more on the management side, time management. They say, Eleena, great presentation. Are you still working full-time on investing? If so, how do you manage your time in order to do both?
Yeah, so I'm still working full-time, and I love what I do at the University of Pennsylvania. But yeah, because it's a team sport, investing in apartments, it's a team sport. Again, you have professional property managers. And so I'm not thinking about these buildings every day. I'm not in the weeds, looking at leases and looking at, reports and things like that. So it doesn't consume my life. So no, this is not something that I'm doing full time. This is definitely something I'm doing on the side, and it works for me. I mean, I will tell you that when I initially started thinking about real estate, I was like the typical person thinking that I would do a wholesaling deal, or I would do fix and flips. And then I realized there's no way I could do fix and flips, because I've got a full-time job, and, doing the fix and flips, that can become a full-time job. So time management obviously is very, very important, but the real estate at this point is not a full-time gig for me in terms of how I'm running it.
Perfect. Thank you, Eleena. So we'll go ahead and start wrapping this up. I want to thank everybody for attending. I want to thank you, Eleena, in specific, of course. We'll be emailing everybody a summary of this presentation with a registration link for the upcoming event and a promo code. Again, this is March 14th. You can reach us, myself, at Camaplan. Either call us or email me at wmucker@camaplan.com. Or you can reach Eleena with her email address, emdinvesting@gmail.com, and we hope to see a lot of you at this upcoming event as well.
Yes, and thank you everybody who's on the line who stayed for the whole thing. I really, really appreciate you, even though I don't know who you are and I can't see your faces, but I really appreciate it, all 26 of you. And William, thank you for moderating. And I just want to wrap up by saying I hope you will join us on March the 14th at Camaplan's headquarters, because I don't want you guys to be like this guy, living on Someday Island, hoping that life will change, hoping that life will get better, okay? If you have the least bit of curiosity about investing in apartments, come to the March 14th workshop. It will just be a Saturday morning, and happy to answer even more questions during that. But I think that if you're the least bit curious about this, it would be well worth your time to come out on the 14th. Okay, thanks a lot, you guys. I really appreciate it.
Thank you. Take care, everybody.